All right, folks, welcome back. This lesson is going to be on Forex and how we can apply this model to the FX market. All right, so if we're looking at the euro dollar, and I'll let you know that's what this is. This is a daily chart for euro. I want you to take a look at how price moved above these relative equal highs right here. Now, once it did that, this took the buy side or buy stops out of the marketplace here. And then it started going lower. What would it likely be reaching for next? Well, it took buy side out here. What do you think's resting below here? Sell stops or sell side liquidity. Now, just to the left, notice these two little devils here, relative equal lows. And with this one and this one, we have two areas of sell side liquidity. Notice this candle here, which happens to be Monday's trading or yesterday's trading. This low did not take out that low yet. Notice that? So we have unfinished business below here and potentially below here. So if this is a daily chart, what is the bias? The very next candle, what's the bias going to be? Bearish. We're anticipating bearishness going in. So let's take that and flesh that out a little bit more. So here is your chart that would be annotated, and you'd have this level on your chart. While you're learning, it's important to have these types of things on your chart. And what do I mean by that? Well, having these relative equal highs highlighted, your buy stops would be resting above here, and the market will go just above that a little bit. And then once those buy stops are taken, for anyone that's short, they're getting knocked down in a loss. And that flood of orders to be buying at the market is counterparty to individuals that want to sell short. So smart money is selling short up here with the expectation it's going to go below this low here, and potentially below that low down here. So today's trading, we had the open. It rallies up a little bit, then careens through the short-term low here and below the relative equal lows here. Now, what level on the downside after this day closed, if we're looking for lower prices, what could we expect it to draw to? Obviously below here and below here, but what price level? 109 big figure. So the big figure numbers, okay, or the zero levels, they're very influential because there's lots of liquidity that is used around those levels. A lot of commerce, a lot of business transactions that come in just for the sake of simplicity. 00 level, the 20 levels, the 50 levels, and the 80 levels. So I dub them institutional price levels. All right, so we're going to drop down to an hourly chart. But before we get into that, I want to revisit the swing trading idea that I taught. Highest up close or opening in this retracement up, and the lowest open or close is here. So I left the highlighted candles so you can match that up on yours. And then we have this old low. So below this old low, if it goes below that, how many pips can it go below that? Well, we have the big figure 109, right? Remember the previous chart here? Watch. Over here, that's essentially the 1.09 big figure. So do we have any levels in here on the fib that correspond to that? Well, we have 1.0919. That's possible. Then we have 1.09101. That's another level that's possible. And we have 1.09011. Essentially almost the big figure, right? So we have a standard deviation from this swing to here. If this is broken, these are only true if this low is broken, okay? So this is a fulcrum point and this is a fulcrum point. So how do we know which level we're going to aim for? Well, we have those relative equal lows at the 109 big figure level. And then we have our fib calling for these levels down here. And the lowest one without going through 1.09 is this one here. All right. On the hourly chart with our buy side liquidity pool level here, the market trades up into that area, absorbing all of that liquidity, then breaking down, takes out a short-term low here and here and here, retraces up in, breaks lower. Then we go into today's trading, the 5th. Prior to the day starting, we know that it's likely to draw below here and then down to that 109 big figure. Have a lot of convergence around that 109 big figure. At the beginning of the day at midnight, New York local time, that's going to be right in here. If we see the market rally up, which is what we want to see, we want to see a protraction in the marketplace where it starts to go against the expected direction of the move intraday. So if we're bearish and we're looking for that 109 level to be traded to and attack the liquidity below here, preferably we want to see it rally first. That's the Judas swing. Okay, that market protraction is what we're looking for manipulation, part of my concept, Power 3. Once the day begins at midnight, we're anticipating a move up. What's it going to be trading up into? This imbalance in here. Okay. So once it does that, it kind of like forms the daily high. And then the rest of the day, you're going to be looking for distribution throughout the day, looking for lower prices. So inside that little shaded area, we're going to use that going forward. So let's drop down to a lower time frame. 15-minute time frame. Here is that imbalance. It doesn't look that clean on a 15-minute time frame, but the hourly is what we're framing it on. So the market trades up into that. Here is the midnight New York local time candle on the 15-minute time frame chart. Opening price is here. Extend it out throughout the day. That is your midnight New York candle opening price. Preferably, if we're selling short, we want to see price trade above this opening price. This is where smart money is accumulating short positions. See that? So the algorithm goes higher, once more higher, and then again right here, and then begins its descent into the daily range low. Now, what's occurring here, this is not buying and selling pressure. The algorithm is offering constantly price above this opening price. Now, every single time it rallies up, just because it does that doesn't necessarily mean that's a time for you to get in. But when you couple that with time of day and price, it becomes a lot better. Notice we have an imbalance in here. So the fair value gap there, and price runs up during the New York open kill zone. Okay, so I dubbed this specific time of day between 7 o'clock in the morning New York time to 10 o'clock in the morning. This is specific to Forex, okay? These times are specific to FX pairs. So if we're looking at this imbalance here, the market runs up and it overshoots the imbalance a little bit, but what's it really go to? The last up close candle, which is a bearish order block. How do we know it's a bearish order block? Because we have the imbalance here and it's trading back up into after a nice move lower. So it's displacement, fair value gap, last up close candle, touches it, there's your bearish order block. Dropping down into a 5-minute chart, everything being as it was on the 15, that's that order block here, just being shown on a 5-minute chart. But I'm adding now the annotation of the New York open kill zone. 7 o'clock in the morning begins here at the end of that line segment, and 10 o'clock is here. So everything underneath this end of the trend line here and below this part of it, this all is during the New York open kill zone. So you're hunting your setup for Forex pairs within that little block of time. So during this time, you're hunting your setup. What price are you looking for? Preferably at or just above the opening price at midnight. Now, if you are a New York session trader, you want to refer to the opening price at midnight, but then you want to recalibrate at 8:30, and we'll look at that in a moment. But for now, just notice, looking at this particular day on the economic calendar, we had a high impact news driver at 10 o'clock in the morning. It was the ISM Services PMI number. Now, so that little bracket of time right there on a 5-minute chart, you're hunting your setup. What is the thresholds that make it high probability? Well, if you're going short or looking to go short and you want to be above the midnight opening price, that's here, extended out in time. But now once we hit this order block here, that was during the early stages of the New York open, right around the 7 o'clock hour. The market drops and then retraces back into that news driver here at 10. So what's happening here is, look closely with this swing low. It went below this low here, and then it rallied back up once more above the opening price at midnight. Does it take out this high? No. Why doesn't it take out this high? Because it has an imbalance here. That imbalance tells you this is an intermediate term high. If we're bearish, it shouldn't take this high out. Now, again, an imbalance or fair value gap associated with a swing high or swing low. In this case, this is an intermediate term high. Not because it just simply has an imbalance, but because the narrative is we're expecting lower prices, and it went above the opening price at midnight, and the imbalance there when it retraces back up into this fake run ahead of the news driver at 10 o'clock, the news, if you will. This movement here is only running right back up into the bearish order block. Last up close candle, the body. I don't like to use these long tails and wicks. I'll refer to them, but I like to prefer to annotate if I'm going to show it in my examples or look to price returning back to the body of the candle right there. So this return into that order block sets the stage for another move lower. We get a swing high, lower high to the right of this candle and a lower high to the left of it here. So we have 3 candles making a swing high. So we start looking for displacement and movement lower. But looking closer, after we had that shift in market structure here on a 5-minute chart, it retraces back up, fair value gap, bearish order block, and news. This is the wild card. Okay, when you have high impact news drivers, this is going to many times scare you out of the trade or stop you out. In other words, if you went short back here and you started trailing your stop loss, this is what that's designed to do, take you out. But inside this shaded area, I want to show you how this model is applicable here in FX. So here's the 4-minute chart, and we're looking for any fair value gap. Do you see it? This candle's low, this candle's high, there's your fair value gap. Isn't it interesting how it just goes right up into there, closes that in, then and only then the market starts to aggressively run below the short-term low here, and then reaching into our objective down here at that 109 big figure. Now, it doesn't quite get to 1.09 even, but it does get to our Fibonacci extension for the standard deviation. It does get down to the all relative equal lows on the daily chart, which is what that blue line is. And look at the bodies respecting that level. Not much movement below it.